finish 2014, 2018, and 2020, but the database we've been building is just taking forever. But I didn't want to wait, another couple months or however long it's going to take us to finish. So I want to go over the results just to provide some color and give you guys some context to help you decide if this is something for you. But let's look at the live results first. So you're going to want to go to the trading page for the Theta engine, which of course is linked from the Trade Busters page. And on the Theta engine page, there is the trade log. It's labeled 2021 trade log. That's the tab. So you can see some of the, right now there's maybe, let me see here, maybe 10 trades that we've closed so far with the bomb shelter in place. One of them I want you to ignore for now because it's the trade that we entered on September 21st and closed on October 14th. Because that one we had actually, this was back when I was still sort of fine-tuning the parameters of the bomb shelter. So this was a 5 delta short. So the long ended up being a lot more drag, and I'll get to that in a second. Basically, on the left-hand side, you'll see the trade log for the short options, which is the core Theta engine strategy. And then the right-hand side, you'll see the trade log for the long or the hedges or the bomb shelter itself. And what I've done is, for the short options, obviously, the trade log you guys are familiar with, the P&L, the P&L multiple, the commission and everything. I've done something very similar for the longs. And as you would expect, so far the longs have been losing as expected because we've just been making money on the shorts, right? So we knew there was going to be a drag. And the first update I want to give you guys is back a few weeks ago when I first introduced and kind of gave the mechanics for the bomb shelter, I mentioned that based on some rough calculations, we expected the longs to reduce or drag your net returns by about 20% of your profits. So what does that mean? High level, if you normally, let's say you sized your strategy to make $100,000 of P&L in a given year, you'd end up with 80,000, right? 20,000 would be lost by the longs that you pay. And this is in an ordinary year, no crash, because on the crash year you expect to make profits from the longs. So after the live trading, right now it looks like it's closer to about 13%, right? And if you want to be conservative, you want to maybe estimate 15%. Why does that matter? Because remember, in order to get the same level of profits as you would without the hedge, you need to basically leverage up or scale up your target, right? So for example, if you normally target 10% return, and let's say you expect the return to be reduced by 15%, so 10 times 0.85, rather than a 10% return, you get 8.5%, right? And then so in order to get back to 10%, you have to scale up the whole system by about 17.6%, right? So you have to scale up. So let's say you're using the risk calculator. Instead of putting a 10% return to calculate your credit target, you would aim for a 10 times 1.17. You would put 11.7, right? So your high level return target would be 11.7%, but you'll know that after taking out the losses from the bomb shelter, that brings you back down to your original 10%. Okay, so I hope that makes sense. But let's see how we actually track this. So in the trade log, you'll see that, of course, number one, I have the loss multiple on these longs. So what you need to recognize is the loss multiple on the long is basically how much they've decayed. Because remember, you're closing out the long when you close the short, right? So on the shorts, you can see all the profit multiples are 0.6 because remember we're setting a 60% profit target. So on the longs, you'll notice that the loss or the decay ranges from 70% or does it 69% all the way up to 85, 87%, right? So that shows you when the shorts decay by 60%, the longs, which are further out of the money by a lot, they're decaying by like 70 or 80%, and that's to be expected. So how does that translate to drag on the net P&L? Of course, you can pick the raw dollars, right? For example, if you look at one of the longs here, the net P&L loss is 570, 550, 575. You just divide that by the profit from the shorts, right? So that's exactly how I calculate that. There's a column called hedge drag, right? So this is the loss of the longs as a percentage of the net profit of the shorts as the budget for the longs, right? So if you take 0.1 and I'll just take a random. So let's say the average decay is 80%. So 0.1 times 0.8, which is 0.08, right? That's the loss. But remember, on the flip side, your profit is only 60% of the original credit, right? So if we take 0.08 and divide it by 0.6, we get 13.3, right? So 13.3 net drag. And again, if I average these, it's right around 12.6 right now. But if you want to be conservative, you can just assume it's 15%. As we have more trades finished throughout the year, of course, you guys can continue to monitor the log and see what the drag ends up being. I think I need to put a average drag on here. I have a trade metrics table, but I don't have the average hedge drag. So I'll add that on there. So one thing to note, I told you to ignore that first trade, the one that was entered on September 21st. So just a quick note on that. You'll see the hedge drag is 33.8%, and that's because when I was originally doing the 5 delta version, when I was designing the bomb shelter, rather than spending 10% of the budget, I was suggesting to spend 25% of the credit as a budget. So, because I didn't think that the hedge drag would be that severe, but you can see, with the 25% budget spent at 80% decay, right? So we can do that number again. So 0.25, which is the 25%, which is that budget when I first started out, times 0.8. So your loss is 0.2. And then 0.2 divided by the 0.6, which is the profit target, you get 33.3, and this thing's right at 33.3. So yeah, spending spending 25% of the credit, it's just way too much drag because your net drag is a third, right? So you don't want to be losing a third of your profits for running this thing. All right, so these are the real life examples of how much drag you expect. And the cool thing also, something that, we couldn't really gauge until we ran this thing live is, so you're losing about 13%, 15% of your profit, right? And then you also have to leverage up the whole system by 15, 16% to get the original net profit that you're looking for. But the interesting thing I've noticed is on the day-to-day, right? And you can look at the P&L of your shorts versus the loss on the longs, or vice versa on the down day, right? Your shorts are losing, but your longs are gaining. It seems to be dampening the volatility of the whole thing by about 10%, 15%. So, and I know that depends on how long you're in the trade, because the longer you're in the trade and the longs decay, they're going to get weaker and weaker. But it's kind of neat to think about if you leverage up the whole thing by 10, 15%, but the longs are dampening the volatility by 10, 15%, then you might be able to get that original level of return even though you're scaled up without increasing your overall volatility, right? It might be kind of volatility neutral. Now, obviously, we haven't had enough trades, and generally this last 2 weeks we've been able to get out of these. I'm looking at the average DIT on some of these 11 days, 10 days, 14 days, when really the average should be something closer to, let me see here, it should be closer to, hang on, 26.4, right? So we did have one that closed around 29 days. But anyways, we were out of these pretty quickly. But what I've noticed, again, in the last month or so we've run this, is that it does sort of dampen your volatility a little bit, which is a good thing. Now, going to the back test. So we're going to move over to the bomb shelter page, and we're going to look at the longitudinal study. So just for context, so you guys can look at the same numbers as I am when you're listening to this, right now I have set the starting net liquidity to $1 million, the target return to 10%, the assumed PCR should be fixed at 27%, and the commission is 1.2%. So remember, this shows you an approximate return of the back test on these 16 years, 2005 to 2020. And what I've done is we manually back tested every time you hit a stop on the short, what the profit would have been as on the long. And you can go to the longitudinal trade log and verify yourself. So again, right now, so today is October 22nd, 2021. I've only done 2007, 2008, and 2015. So whenever the shorts got stopped, I manually looked at what the long would have been as a profit. And when the shorts won, which is most of the time, I took a few samples of the loss on the longs because I knew that the results were going to be pretty similar. Like, in fact, back in 2007, 2008, most of the time, the longs pretty much decayed completely and just lost the whole thing. They were worth like nickels or worthless. So the loss was pretty much 100%, most of the time 90%. And I don't know why exactly that. Maybe just back in the day, SPX was lower, so the strikes on the longs were lower, so they just ended up really not holding any value, which is fine. And again, if you want to be conservative, just assume you're going to lose the whole thing. But remember, from the recent testing, not testing, but the recent trading, we're losing about 70 to 80%, 85% when the short hits the profit target. So let's look at these individual years. So there is, on the longitudinal study page, there is essentially another column now called B shelter, or short for bomb shelter. And you can see the updated return and max drawdown. And of course, right now, that's only for these 3 years. So let's look at a good year first, 2008. You can see that without the bomb shelter, the return was negative 10%, 10.3. And with the bomb shelter, it did lower the drawdown slightly. It's negative 9.7. And So it actually added about 0.6% to your return, right? And the premium capture rate improved, right? Without it, it was negative 15.8, and now it's negative 14.6. So you did get a net return. If you scroll down a little bit, actually, you'll see three sets of graphs for 2007, 2008, and 2015. One graph is the return of, so this gives you a visual idea of the 90 or the theta engine versus having the bomb shelter. And then there's a graph of just the raw P&L of the hedge of the bomb shelter portion itself. So remember, looking at 2008 first, you can see essentially as the crash happens, the drawdown for the red line is a little shallower. So at the end of the year, the return for the bomb shelter strategy is overall, the combo, of course, is a little bit better. And obviously on the P&L graph, you see that this line trending downwards until the summer because, of course, the hedge is losing when the market's not going any crash. And, of course, the profit just basically explodes, right? So that's kind of a given. Now, before you say, hey, why is this only adding, less than 1% to my profit? Remember, this thing was designed only to really react in a severe, crazy 20% gap, right? Which has never happened. So really on anything other than that, I was not even really considering this to be a profit maker, right? I was only testing this just to see, hey, if I have it anyways, incidentally, would it have done anything on these last 16 years, right? So in 2008, yes, it added. So it was worth doing because at least it didn't make you lose money, right? Now, if you look at 2015, again, if we scroll down to the graph, this is a little more evident because 2015 had a really, really violent sell-off right around August, and then there was like a massive gap on one of these days. I think it was like August 24th. I forget exactly which day. So you can see that the two lines are pretty much neck and neck, and right around until August, in which the blue line, which is no bomb shelter, just crashes, and then the red line, which crashed much less, right? So the year ended up pretty good. At least above the line with no bomb shelter. And of course, the P&L graph, obviously, you see just the hedge is losing money, and then it just takes off, right? Huge profit. And so looking at the actual return, without the bomb shelter that year would have been negative 4.9, and then with the bomb shelter is negative 0.2, so it added 4.7% of return, right? So that's pretty good. It cut the drawdown by 4%, right? And remember, this is sizing the strategy to return 10% normally. So we're obviously just focusing on the not so good years. So just a quick note on all the other years, the core strategy, the theta engine is making much more than your 10% target. I mean, that's how it works, right? The long-term CAGR is 10.2%, which is right on target, but that's because you have these years where it's negative, and then you have years that are positive. In fact, some of the years are way above what you're targeting. But I haven't back tested the good years, and not that I necessarily need to, because remember, on the good years, you just assume that the bomb shelter is going to lose that 10-15% of your profits. So for example, if we take a year like 2005, it's 18.1% return without a bomb shelter. So if we take out 15% of that, 18.1 gets reduced to 15.38, right? So 2006, it's 15.1, take out the 15%, that means your return gets reduced to 12.8. So that's a fixed drag that you just expect. You just have to budget for that. That's just the purpose, right? So if you decide you want to use the bomb shelter, that's the cost that you're going to carry, right? So all that makes sense, right? So on the good years, it's a fixed cost. On 2015 and 2008, it did actually help your bottom line a bit, so that's all good. So the worst case right now, when you look at 2007, I kind of saved the worst for last. In 2007, without the bomb shelter, your return was negative 6.9. With the bomb shelter, it was negative 8.2, right? So it actually increased your loss by 1.3%. Now, that's not horrible, but for a hedge, remember, the worst thing you want to do is spend money and then not make anything and actually cause more loss. But that's just going to happen sometimes. That's the thing about hedging. It's not perfect, right? And if it was, then everyone would do it and there'll be no risk, right? There's always some kind of risk involved. So, and again, that year, without the bomb shelter, you had negative 9.2 premium capture. With the bomb shelter, it was negative 9.6. So it actually, again, you lost premium because of the bomb shelter. So if we go look at the graph, you can see that the red line is pretty much under the blue line most of the year. During, it looks like there was 2 or 3 major legs down in the market that year. If you look at the P&L graph, you can see it actually, the P&L spikes above zero briefly, but then of course you lose all of it until about July, August. There's a big profit bump, but it wasn't enough to pull you positive for the year, and it kind of just went down. So 2007 overall, the bomb shelter lost money. which again, you expect it to. It's just that this was one of those years where the hedge lost money, but the core income strategy also lost money, right? And this is something that my friends and I have basically been calling the dead zone, right? So under normal circumstances, if your income strategy or the theta engine makes money, you want the hedge, you expect it to lose money, right? So overall, you're still positive. On a severe crash, your income strategy loses money and the hedge makes money. Now, it may not be enough to make your entire income, P&L positive, but it did lessen the loss. It lessened the drawdown. So again, that's a positive result. But in a year like 2007, and I suspect 2018 as well, where the income strategy loses money, the hedge loses money, and it's just because something about, because remember, the exact outcome is going to be path dependent. In this case, the market went down in a way that stopped you out of the income strategy that caused you to lose money, but it wasn't enough. VIX, didn't spike enough to basically make the hedge do much of anything, right? So that's what we call the dead zone. Income strategy down, hedge is also down. And in fact, this is specifically the kind of situation I was trying to solve with the vibranium shield, right? That's the 'cause the bomb shelter was designed only for the gaps. And so, again, we don't expect that to ever happen. So what do we do for when there isn't a 20% gap, but we do have a regular, or not regular, but when we have a sell-off, that's 20% or 30%, but that not necessarily a true gap. And that kind of market is specifically what I was trying to solve. That's the hole I was trying to fill with the vibranium shield. And I came as close as I thought I could because, again, hedging is not perfect, but I got something I felt comfortable with and something that's worth looking into, and that is going to be the next episode. That's the final piece, the third piece to the Trinity system. Okay, so I'm going to wrap up the testing of 2018, and again, I suspect it's kind of one of those other dead zone years. And just before I let you guys go, just a quick look at why this happened in 2007. So remember, you can go to the longitudinal trade log and you can look at the manual backtested result. So what happened was, I'm going to scroll through real quick. Number one, there was eDelta Pro wasn't the data back then. There was not a lot of expirations to choose from. So eDelta Pro, when I set it to do 90 DTE, sometimes it picked weird ones. It would pick way over or way under, and you can see on the trades there's some 50 DTE, 60 DTE. And remember, if the short is at 60 DTE, then the long would have been even less than that, right? It would have been like 30 or something. So number one, some of these trades, the longs were just entered with not much life left. And if you look at the days in trade on some of these stops, so I'll pick an example. There's a trade entered at January 31st, 2007. So it was 80 DTE, and the long was at basically, let me see here. I think it was something like 40 or 50. So it was 45. And this trade took 27 days to get stopped. So by the time it got stopped, the long was only 18 days left, right? It's pretty much almost expired. So you would expect it really to not do anything. And now granted, that one did return a little bit of a profit, but there's a lot of situations where the shorts got stopped and the long either lost money or basically was not profitable. And I'll give you an example. In around the September timeframe, August timeframe, this was the later fall kind of leg down in 2007. There was a lot of these trades where the DIT was really high, right? So basically these were trades that were getting stopped and pretty much in the end of the life cycle of the trade, 58 days, 68 days, 65 days. So this is, imagine being in a short for 2 months and then getting stopped, right? This is kind of the worst case scenario where we haven't really seen that this year or even last year. But I mean, you would probably feel pretty bad about that, right? Just being in a trade that long and then finally getting stopped. And the worst thing is at those kind of high DITs, the hedge is pretty much all decayed, right? There are even some circumstances where the time in trade for the short was longer than the DT of the long, meaning it was already gone. Like you had no hedge left. So this is the kind of situation where we haven't run into this live yet, but you could use some discretion. Like if you are in a position where you want to have the bomb shelter, but you're in the trade so long that the bomb shelter is just decayed, it's almost worthless, or it's expired already, you could take the discretion just to close the short regardless of what the situation is, right? So that's the kind of situation where it gets a little bit off sort of the mechanical path of trading this, but at the end of the day, it's all about risk management. But I just want to show you that this is the kind of year, the kind of situation where it's the worst case scenario for a hedging strategy, right? The short is in these trades for a super long time. The long is really weak or really decayed, and so when that leg down in the market finally comes, the hedge pretty much doesn't do anything. So that is the kind of scenario which we can lead to what we call, again, the so-called dead zone, where you're losing on the income, losing on the hedge. But overall, again, going back to the longitudinal study, I suspect 2018 will be similar because remember we had that slow grind down in Q4, which really didn't activate much hedges. So 2007 and 2018 were ultimately the most challenging years in this 16-year study. But if you think about it, so there were 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 12 years out of 16 that the income strategy were positive, right? And so those are the years where you really didn't need the hedge to do anything anyways. And then of the kind of the 5 crash years, 2 of the ones we've tested so far, the hedge did something, right? And then 2007, it didn't help. 2018, I suspect it won't. 2014, we have to see. 2014 was a flash crash, like the one-day intraday flash crash. So that's sort of a unique scenario, and I'll be interested to see how the result pans out. But again, overall, I think the results they hold up, But the point is I want to kind of put this data out here and let you guys decide for yourself so you're very clear on what this thing was designed specifically for, what you can expect it to do, and what you expect it to not do, and kind of the pros and cons. So you can decide for yourself if it's something you want to add. So anyways, let's leave it there for now, and we can look forward to the next episode, finally introducing and getting into the nitty-gritty for the Vibranium Shield.